Yeah. All right, we're gonna give it a minute for people to join in before we start talking our heads off.
Okay.
All right, Alex, let's do this, man.
All right. All right. You want to share your screen? Or you want to open it up?
All right, hey everybody, what's up? Welcome back to the live. Y'all know who we are. Alex and Kirby on one side or the other. I don't know what side of the screen we're on right now. Was dealing with a couple little technical difficulty issues. But today we're gonna talk about the stock market itself. And for everybody out there, we've heard y'all. I know we always talk about the mentality, the mindset, and different avenues and things like that go along with investing. And the reason why we talk about that most because it's the hardest in practice and the hardest to actually apply. Now, the easy part, once you get the mindset, the mentality, and things like that, everything else just works itself out. But today we hear y'all. We're gonna talk about the things that y'all want to talk about. Hey Kirby, why don't you shut up? Hey Alex, why don't you shut up and just talk about how to make the money, and we'll figure the rest out on our own. And in truth, once you have the mindset, making the money part is easy. But when it's just come to just making the money, what we talk about in practice is simple, but what happens in reality and how you apply it is a little bit different. I'm not gonna say it's hard. The hardest part is the mindset. The making the money part is the easiest. But Alex, what you guys say about that?
Yeah, I think that's why we talk so much about mindset is, you really got to change the way that you think about money, change the way that you think about um, almost everything, life itself. And one of the books that actually opened my eyes to thinking differently about it was Rich Dad Poor Dad. If you guys want to check that book out, it's actually really good on explaining, the mindset that you have to have when becoming an investor. There's a lot of things that you have to look at life differently to understand. And that's why we talk so much about mindset, because without the mindset, all this stuff is just numbers. It doesn't really, it won't make a difference if you don't have the mindset on how to invest.
Right. And then now, Alex, you see I'm sharing my screen here. And then
Yeah.
I don't know if you can see the chat or whatever, but if you can see the chat
No,
while
I
we go
can't.
through this. Okay, so I'll be doing double duty here trying to figure out the chat while we go along this process because Alex just slacking. But anyway, so here we go. So one of the main things that I see, and this is strictly talking about money. One of the main things I see is people don't understand what the stock market is. And Alex, you having more conversations now with people when it comes to talking about investing, talking about, making sure they secure their financial future. What's one of the main questions that you get for what the stock market is, or what's that main question that you get?
I mean, I don't know if I get questions like there if there's a main question, but there's main like there's statements. People think that it's super risky. They don't understand it. And I get it. I mean, and I've told people, looking at like a chart like this that you're pulling up, like I remember myself, 7, 8 years ago, where I would see charts, but I had no idea what it was saying. I didn't understand anything about, you know, what what the chart was doing, how to read it or what these traders were looking at when making money. So I think it looks very intimidating to most people that don't know anything about the stock market. You look at a chart and you don't know what is going on. You barely even know where to find the price of the stock because the screen is just moving everywhere. So it can be difficult to understand just at a glimpse. But you know, it's once you start doing homework, it's just like anything else. It's just homework, studying, and little by little, it starts to piece together and make sense.
All right. Well, how I'm gonna start this off. I'm gonna start off with the one that takes little to no studying. Little to no studying. We're gonna talk about retirement accounts. Let's shoot up that one first. And just for people
Yep.
that don't know what retirement accounts are, these are some of the versions of different retirement accounts: traditional IRA, Roth IRA, um, SEP, Simplified Employee Pension, Solo 401k, Roth IRA. You got Thrift Saving Plan, SHA. And then, of course, here's the article. Here's the description on different ones. The main crux, the one that most people know about is this one right here, the 401k and the traditional 401k, excuse me, and the Roth 401k. Uh, but Alex, I'm gonna go in there first. I'm gonna get the descriptions of one. The traditional 401k contributes are made with pre-tax dollars and withdrawn in retirement tax at ordinary income. So that just means that your money goes in before they take taxes out from your paycheck. It goes into an investment, which is the 401k, and they don't take taxes out. And then when you take it out in retirement age, it's counted as ordinary income. The Roth IRA, the contributions are made after tax dollars and withdrawals are retirement. The withdrawals and retirement are tax free. Excuse me. And all that means is when you get your paycheck, they'll take out the taxes first, then they will put the money into your investment vehicle, which in this case is the Roth 401k. And then when you hit retirement age 59 and a half or so on and so forth, then you could take the money out using the 4% rule or however you want to do it. And there will be no tax penalty from the IR and the S. And then of course you got the Roth in the traditional IRA, which is also the same complex that's out there with the same as the Roth and traditional 401k. So that's what we want to talk about first. So Alex, what do you like and dislike about these two different vehicles?
I think for the traditional accounts, the or traditional 401k, I would say the thing that I don't like the most is that once you put that money in, it's pretty much locked in unless you know pull it out and pay a penalty, or unless you leave your job and cash it out or take a loan against it. It's locked in. It's like super locked in until you hit that age 59 and a half to where you can pull out withdrawals. Um, that's my biggest pet peeve with the accounts, really. I mean, at least with the Roth IRA, you can pull what you've contributed out of the account without being penalized. That's a cool feature to that kind of account. And really, I've only done that in scenarios where I need extra capital to go into a real estate deal. So it's not like I'm pulling it out to blow it or nothing. Um, but the feature having that ability to where your money isn't like locked in a jail is nice. So that's my biggest pet peeve with that account or with those accounts.
Right. And then so for most people that's out there, and so they understand the 401k or the Roth IRA or the IRA itself, individual retirement account, that just putting the money into the account itself is not investing. They
Right.
all those are different accounts, just like a checking account, just like a savings account, or what have you. The key to those different accounts is they provide you different investment vehicles that you can invest in, and then that's how you grow your money. Just saying, because most people, I think the stat out there is 84% of people don't even know what they're investing in their 401k. So that's the nuance that we're going to talk about. One of the big things that I see, or issue that I see with people with 401ks, is the fact that they're investing in something, but they don't know what they're invested in. One thing for sure, two things for certain: if you don't know what you're invested in and you don't care about what you're invested in, the person who's invested in that fund don't care either. And I
Yep.
believe how it's set up now is most employers, they put your retirement into a target date retirement fund. So they just base it on your age. They base how far you away from 65 years old, and then or 59 and a half, not sure that number, the distance, and then how many years in between, they'll just put you in that target date retirement fund. So if you retire in 30 years, 20 years, 25 years, then they'll have a fund for that. Uh, and then, so Alex, before I get into that, what is how you feel about the target date retirement fund?
Yeah, I mean, I don't use what the employer puts you in. I wouldn't recommend anybody to go into what a employer would recommend. But I would say if you're going to start investing in a 401k, understand what it is. You know, it's not a money market account. You're not putting your money into a savings account and then it's bringing you an interest rate. You're putting your money into an account that goes into stocks or it goes into bonds. So you're purchasing shares of investments. So understand that. I think the majority of people don't grasp that concept because lately I've been hearing people say, hey guys, the market's coming down, stop contributing to your 401k or put less in, because there's this fear that like, oh, the money is just going down. No, if the shares are going down in value, you want to purchase more of them. So in order to do that, you either contribute what you've been contributing or you increase your contributions so that you can acquire more at a discounted rate. So you want to be putting more in downturns like this, like you can see on Kirby's screen to the top far right. This is where we're at right now in the market. You so understand that first when investing in a 401k.
Right. And the nuance of this whole thing is understanding where you're at in the market and what the market is doing. So let me pull up this diagram, because like you, Alex, you heard people saying, oh, the market's down, should I take my money out of the market, or what should I do, the market's going down, and then they get scary and they get fearful and they think that the world's coming to an end. So let me pull up this diagram for you, just so people can see what the history of the market itself. All right, so Alex, can you see my screen?
Yeah, yeah, yeah.
All right, so yeah, so here, this right here is a dollar. If a dollar was invested in 1870 in the S&P 500, just in the S&P 500, the market itself, and then look at all the different trials and tribulations as a nation we went through over that time. We got the depression in railroad strikes. You got I'm just calling out some big ones so people will know what it is. World War II and its influences. You had the Great Depression and World War I. You had the inflation bear market of the 79s and 80s. You had the inflation. You had Vietnam. You had the lost decade. You had COVID. You had the great financial crisis. You had all these little things. Sorry if the picture is a little blurry, but you had all these things. But a dollar in 1870 till now will be worth $31,000. It still goes up. You see, the market comes down in little dips over time, but it still goes up over time. So that's one of the nuances here. So like right now, we see that the market is down. We see it. The market is down from the highs. I mean, I've seen on social media people saying, "Oh, look at Trump. I didn't exit my 401k because I knew this was coming," and all this other crap that's out there. But let's look at the. I'm going to the monthly chart now, Alex. Let's look at the history. This since 1994, 1993. And look at the market. The market, this is the S&P 500 or the ETF of the S&P 500, but this is what people consider the stock market. It's not the Dow Jones, people. It's not the NASDAQ. It's the S&P 500. The Dow Jones just look good because it's a big number, but it's only concentrated of 30 stocks. So S&P 500 is the real benchmark because it's 500 stocks. From 93 forward, we was at $42.81 a share. And then now we're at 613. Alex, you went to private school. What percentage multiple is that? About 1,000, about
Say the numbers again.
15, 42 dollars to 613.
Yeah, it's like 14, 15x.
14 or 15x. That means 14 or 1,500% increase if you just invested in the market since 93. But again, look at what happened with this right here. This right here. I know I got a lot of arrows here. This was from a Discord class. And speaking of Discord, description is in the link is in the description for anybody that want to, have conversations. We talk about this stuff way earlier before it happened. We even talked about this downturn way before it happened, so we can prepare. But the link to the Discord is in there. It's free, so please join that. But look, we're right here. Great financial crisis. It's just a blip on the radar when you zoom out and see the big picture of what's going on. We had COVID. We got COVID right here. Look at it. It's just a little blip in a big grand scheme of things. When we inside of these situations, it seemed horrible. It seemed horrible. But then you have this. Then you got the Fed's increasing the interest rate right here in the 22 year. Then we see nothing but a downturn for a whole year. But now look where we're at now. After all the madness, we're still higher in the future than we was yesterday. And that's the mindset you got to have when you're talking about the stock market in general or investing in general. You're not looking at these different situations that's going on in life. You just want to keep going on. So, Alex, what's your motto when you're investing just in the market? What's your motto when it comes to on a market downturn? What you do or when the market's going up?
In a market downturn, I am buying aggressively, and trying to average down my cost basis. So, in a downturn, you don't know what the market exactly is going to do. You don't know if it's going to come down and go right back up like we saw in COVID. So as it's dropping, you want to just keep buying. Keep buying. The lower it goes, the better, the more shares you can acquire. In an upturn market or a market that's bullish, I'm pulling back on my investments. I actually took over your strategy where I'll invest 50%. The monthly amount that I'm contributing to that account, I'll invest 50% of it, and the other 50% I'll keep in cash, basically cash reserves for a pullback like this. And typically in a up market, I'm actually switching to real estate. So I will look for a deal. If there's nothing that looks worth buying in the stock market, I'll just move to a different investment vehicle. So that's another thing.
Right. And then so as far as the retirement aspect of it goes, like you said, is locked up in there. And then we have a similar strategy here. And then so for me, I just draw lines. That's what I do. I draw lines on the chart, and then I just wait for the stock market to give me the prices that I want. So again, right here is 613. Again, this is a SPY. This is the top of the market. So this right here is the top of the market here. So when I saw the downturn start happening, only thing I did was I put a line, and the only thing I did was the high minus 5%, there's a line. Minus 10%, there's a line. Minus 15%, there's a line. Minus 20%, there's a line. And the lines is not for me to be scared because the prices are coming down there. The prices are for me to get excited so I can find more money to put into the market. So when the market dropped past the 5%, the first thing I did, or when it got close to the 5% line, I wasn't going to do it till it got to 10%. But when it got past the 5% line, I knew it was coming to the 10% line. And then so what did I say in the Discord, Alex, 2 weeks ago? I upped the 401k to max it out early so I can get more money into the market while the market is going down. So then look, and again, people, I didn't just draw these lines today. I drew these lines weeks ago just to get prepared for this. And then so it got down to the 10% line. And Alex, as you know, outside of the retirement account, I'm still investing. But in the retirement account, I just started putting more, start maxing out the Roth IRA faster and faster and faster, start maxing out the 401k faster and what have you. And then my ultimate goal, if it gets down here to 20% down, God bless us all. This is nothing but an opportunity. This is nothing but just shares on sale. Only in the stock market, do we run from sales. Now, if it was at the mall and they said Jordans was on sale, everybody would be running to the mall to grab them. But now it's a asset on sale, then nobody wants no part of it. So
Right.
that's one nuance. But I have the inverse mindset on it, on what I'll do in the market. Most people fearing, like you said, you heard people say talk about exiting 401ks. Everybody talking about, hey, I think I'm just gonna sell everything now and wait for it to all get figured out. And then I'm gonna show you what happened. I'm gonna show you what happened in 2009. I'm gonna have to go back here, and then you got to witness these ugly arrows again. So the market started going down in 2009. The news outlets start telling everybody a recession. Market start tanking. Right here, March, I think this is March 9th, March 25th, somewhere in there. It's like March 9th, March 25th. That was the low of the market. Magically, that was the same day where the most people exited their 401ks at the bottom, right there. So they didn't exit up here, they exited down here. And then the market proceeded after all these, mom and pop people that was in 401ks, whatever, and thought, oh, I got $12,000 in my 401k. I don't want to go to zero. I'm just going to sell it right now to save what I have. And then magically, the stock market started going up again while nobody was paying attention. Nobody didn't enter. I mean, like the 401k investors, the ones that sold down here, they didn't enter back into the stock market until the news announced over there in 2013 that, oh, we're at all-time highs again. So they missed this whole increase, and this is from 67 to about 153. So that's 200% gain. They missed that whole 200% gain because they wanted to exit the market, and then they got back in here. And then most of them didn't get back in and buy an index that's indexed to the S&P 500. They just went back to that traditional target retirement fund. Depending on age, they're probably more in bonds than stocks. And then they missed this whole rally from 154 all the way to 623. So now we're here. Now we got another blip in the radar. We going down. We got another one of these going on. We got another little situation where the market is coming down and everybody's looking to exit again. And then you're gonna have people like Alex, people like the Warren Buffetts, the people like the Ray Dalios, and all those big time investors. They're gonna come in and buy your shares when you're selling them off at a cheap price, so they can get it up here. That's how it works. So the key thing is just like this statement say: don't stop investing. There's always a reason to not invest. But the S&P 500 has returned 10% per year on average since 1950. That's before most of the people that's watching this show right here, before they was born. But it's averaged 10%. Even with all of this crap, housing crisis, 9/11, Iraq war, Y2K, dot-com bubble, Gulf War, savings and loans crisis, 18% mortgage rates in the 80s, stagflation in the late 70s, Nixon resignation, Vietnam War, Cuban Missile Crisis, the Korean War, JFK getting assassinated. Through all of that, the market still has went up over the time, over the long-term view. And so that's one of the things and nuances that I wanted to bring out there to the people to understand is only thing you have to do is just keep investing. Sounds simple, sounds very simple in saying it. The key is to actually apply it and do it. That's what you got.
Yeah, and I mean, like last night, someone had asked me because I was explaining to them the simplicity of actually just investing in an index fund or a mutual fund that mimics the S&P 500, and they asked me, but you have to keep up with it every day, right? And the answer is no. I mean, just set it and forget it. Just keep buying. This is long term. So imagine you're buying right now, and then you're looking at the market day to day where it's at right now. You're gonna be freaking out because you're just gonna be thinking, my money's going down. I mean, I remember back in, 2022 when they started raising interest rates. We had I had my wife's 401k maxed out. I think she was contributing about 43% or somewhere around there. But it was like every time the contribution hit the account, it was like all it did was break even because the market was just dropping that whole year. But in return from that bottom all the way up to now where we're at now, it's grown a lot. So you want to continue to buy. I mean, those shares are just going to be they're just at a discount. So as soon as once the market comes back up, turns around, those shares can multiply. So keep buying, stay calm, and just focus on your day-to-day life. Don't even worry about what's going on in the market. If you're invested for the long term, just pay attention to what you got day by day.
Right. And one of the questions I get is it possible to become a millionaire with the 401k? Alex, what's your thoughts on that?
Yes. If you are invested in the right investments, like we said, invested in a mutual fund, directed towards, say, the S&P 500, the NASDAQ, those are the two I use. Kirby, I think you do the same. So recommendation, do not allow your employer to manage your investments. They will charge a lot of fees. Do some research on the investments that are given to you as options in your 401k accounts. Every 401k account is different. Some have, I think my company gives about 20 different account or 20 different stock options. Do research on them, pick the right ones. It'll show you the growth rate. Look at those. And the key also is contribute to those investments. So like Kirby said, in down markets, maybe consider increasing your contribution. And up markets, maybe just put it at what the employer will match it at or what you can afford. So those are key points to keep in mind.
Yeah, and I'll just add maybe one or two more to that. Is it possible to become a 401k millionaire? Yeah. Is it possible to become an IRA millionaire? Yes. But it's caveats to that. If you have 25 years left to work, then yeah, you can. It's possible that you could become an IRA millionaire because in the IRA, the most you can put in, or Roth IRA, either one, the most you can put in is $7,000 a year. So $7,000 a year, you do the math. Seven times 25 years is what, Alex?
Yeah,
Put
he's
you on the
always
spot.
175.
That's 175,000. If it compounds for 25 years at an annual rate of 10%, if you invested in a mutual fund that's indexed to the S&P 500, I believe it's around $700,000, $800,000. I believe that's where it's at. But with the Roth IRA or IRA in general, the way that you get the money is by time. So the longer you're in it, so the younger you are when you start maxing out that Roth IRA and you putting that $7,000 in and you indexing it to the NASDAQ or you indexing it to the S&P 500, then the more likelihood of you hitting the millionaire status in your account, $1 million in your account when you hit the age of 59 or 65 is higher. So now contrast that to the 401k. The 401k, yes, it's possible to get there, but you can't get there. And it's the same, time dynamic, but you can't get there only putting in the 401k match. You can't just go in there and put 3% and think that, oh, I'm gonna get there. You got to put 7-8%. I think the number is actually, if you have 40 years or 35 years of work still ahead of you and you put in about $700 a month. Now, of course, if you're younger, you can put in less, but you put in about $700 a month, so 350 every 2 weeks or whatever, you can hit $1 million by the time you're 65. But it can't be just, oh, I'm just gonna put the match. I'm just gonna put $150. The employer gonna put $150, and then I got 20 years before it's time to retire, and something's gonna shake. It's not gonna happen. But the key nuance of that is you have to make sure your investment is indexed to a fund that's mimicking the market. If you still in a target retirement or things like that, and you're still, you're only putting 3 to 5% in, and you just doing whatever the default investment that your employer put you in, it'll be very hard to hit that millionaire status or have $1 million in your account with just the just putting in 5-6% and your employer match. You won't get close to that number because with 401k fees and then the fees that's attached to those target retirement accounts, it will make it damn near impossible to get there.
Yeah, exactly. Kirby, do we have any comments?
That's a good question. I'm over here. What do you recommend for older people on fixed income?
You gonna have me answer that one? man.
Oh, I can answer it, but you can go ahead.
No, let me. So for people on fixed income, I mean, I think the biggest thing is going to be finding the cheapest way to live, or the most frugal way to live. So I know, Kirby, you helped your mom with this, and it's just, come up with the plan, come up with the budget, and look hard enough. I mean, the rate that she pays that you had told me for her rent is almost unheard of in Florida. So, but if you do your due diligence, you're constantly looking, you present yourself the right way to landlords, things can happen. You can find cheaper living, but it's going to be, live on a budget. So if your income is fixed, then, maybe even if you have extra funds, like in your mom's case, Kirby, consider investing in different assets that will provide you an income, dividend stocks, maybe I won't go too into depth, but there's other income options on the stock market as well. But something to find yourself a few extra dollars a month or so.
Right, and I'll piggyback on the find a few dollars aspect. Is come up with a side hustle. I mean, especially people that's in the retirement age, and they over 60. You didn't live 60 years on this earth. You picked up a skill or something that you can monetize. You got a lot of years on earth, and a lot of the stuff, and of course in this technology world, it's still people out there that still want the analog world. So you can bring stuff that you remember from the analog world, create a side hustle, create more income. But to Alex's point again is, yes, you still got to invest it. Is it too late when you're 60 years old to invest into the SPY or invest into the market? No, it's never too late. Only time it's too late is when you start after you're dead. Then it's too late. But besides that, it's just finding income and things like that. And Alex, to your point, is what you said is true. Is finding cheaper ways to live. I know people in society today, they have this mindset of, hey, I gotta have XYZ, I gotta have, vaulted ceilings, my ceiling fan gotta have 12 speeds on it. You know what I mean? I done had ceiling fans in my house. I think I done cut them on like 10 times in the 15 years I've been here. But people need all this fancy stuff. Only thing you need to do is survive the event. I mean, go get downsize, get something smaller, get something cheaper, have extra income to actually do it. And I'm talking about all age ranges, not just people on fixed income, but people on fixed income. Unfortunately, they got screwed. They got screwed. They've spent all their years, all their time investing into the Social Security system, the pension system, and things like that. And then now the government is screwing them over. I mean, I don't believe Social Security really been adjusted to inflation since the 1970s. I know Biden did something a couple years ago that raised it like 8%, but it's still behind the curve. Majority of the people that's on Social Security, especially if they live in Florida, most people that's on Social Security, their Social Security checks can't even pay their rent, let alone a mortgage. So even at 60, 65 retirement age, you still got to find a way to just create more income and live frugally, and then still try to find a way to grow the excess income that you do have to make a little bit more, just so you can have survivability space, especially with the interest rates that we have going on right now and inflation that we have going on right now.
Exactly. Do we have any other questions? Can't see.
Yeah, no, we don't have any more other questions on here, but probably because you went live like 62 times today. That's probably what people were thinking, like, oh, this live number 50, But yeah, so even with that, but the market itself, let's get back to the market itself. The market itself, the way you make money is, again, on the downturns. You want to be able to put as much money as you can in these downturns, So like right here, I talked about how, I switched the 401k up to make sure I'm putting more money in and max out the 401k. Of course, maxing out the IRA and things like that. But the thing is, what I'm waiting for, and hopefully it happens, we got the test right here, the 8-day moving average right here. And I can zoom in more for viewer purposes. We testing an 8-day moving average right here. I'm 100% fine with the 8-day moving average being the resistance and it get rejected back down. And we all know Trump good for a tweet or something over the weekend. He about to put 500% tariffs on somebody. So we gonna get that, so I could see that being resistance. But this is my fun zone right here. This is my fun zone because now I get to tell my son, no, we ain't going to do nothing because all the money is going into the market. So that's the key aspect that I'm looking for is everything going to the market because I want all these shares at discounted rate. And then for the people that want to know about different stocks or whatever, what have you, I still use the same metrics. I still look at what the market's doing. So now we see the market here down at 10%. Most of the stocks that all the people love, the Palantirs, the SoFis, the what else we got out there, Alex? The ones that everybody love. You got the Nvidias, which one? Teslas, what have you. So the marketing came down 10%. So let's look at Tesla. So the market came down 10%. Look at Tesla. Tesla's down almost 50%. So what I do is I literally, so let's say it's a stock that I want. So now I see the market's down here. It's down 10%. I know the stocks that I like is down more than that. So then I look to buy these individual stocks at the line. So here is at the 10% line and it's holding right now. I will be sitting there. If it was Tesla, I'll bring it back up. If it was Tesla, I'll start building a position in Tesla or I'll start buying more in Tesla. If it's SMCI, as y'all see with all these lines, y'all know I got SMCI. This is the area, and I was buying it yesterday when it came down here to the 50-day moving average on the SPY. I was buying it right here at the 39 level. That's where I'm at. And then I don't care what it is. What Palantir, PLTR?
Yeah.
Palantir, same thing. You see, it was at 125. It's at 80. It was at down to 80, so it was at 40% drop there. Same thing with SoFi. SoFi, same thing. We got down here. We here in this area. I'm picking up shares here, and actually, I was buying SoFi in these areas. And then that's how I do it. I leverage everything off of the SPY and the QQQ. Alex, do you want to talk about the difference between the SPY and the QQQ?
Yeah. So the S&P 500 is the top 503 companies in the United States. These are companies that everyone's familiar with. There's Amazon, there's Wells Fargo, Bank of America, Chevron, ExxonMobil, Walmart, all the big companies, everything that you see going out and about, those companies are within the S&P 500. So essentially, and I like the quote that Warren Buffett says, what he says, when you buy the S&P 500, you are buying America. So that's, the best way to look at it. The QQQ or NASDAQ, those are the top 100. I don't know if there's a couple more in there, but top 100 stocks in the tech sector. So you have like NVIDIA, which is like the chip makers, Facebook, Amazon, Apple, Microsoft. So all the top 100 tech companies are in the QQQ. So because it's tech companies, they're going to be a little bit more volatile. So you will see more drastic ups, more drastic downs than the S&P 500. But I'd say a good rule of thumb is, long term, you might see the NASDAQ grow about 15%. Long term, you'll see the S&P 500 grow about 10% on an annual basis.
Yeah, and then it's a couple things I want to add, and then correct one quick statement that you had was the Qs and the SPY. They have a lot of overlap. A lot of overlap, meaning the companies that's inside of them. The reason why that the NASDAQ is more volatile is because it's a concentration of those said tech companies that you have. Those same tech companies are in the SPY, but it's spread out over 500 companies instead of that, 100 matrix. And then as you see here, I got the QQQ chart up. And then, of course, these lines mean different things to different people. But for me, I was just following a trend line here, then following another trend line, then it broke. And then that gave me my confirmation that we is going down. We going to take it down. Yep, we going down. So we going down. And then, but this right here, this yellow line here, that's 10%. That's 10%. Or I think that's 50. Is that 10%? I forgot what this line was. Hold on one second.
Kirby, is anyone saying there's any issues with the screen share? I can't see it. I don't know if
No,
It
I'm not having an
says
issue.
okay.
Yep,
Hopefully
good
it's
here.
still okay.
Good here. All right. So yeah. Here we go. I'll just show you how I did the numbers. 440, 81. Wait, let's ask the chat. Can everybody still see the screen share? All right. So somebody tell me something different. I ain't changing. All right. So what I do is just 540, 81. That's the top. And then the only thing I do is just minus 10%. Minus 10%. That gives me the 46. I mean the 48 the 486. That's close. It ain't directly on the number. But you see it already broke the 10% range. And again, back to the volatility. Even though the SPY, again, the volatility is not as exorbitant as the Qs because it's more shares to alleviate the volatility than in the Qs. And then so even though the SPY is down 10%, look at the NASDAQ. The NASDAQ, pushing at 12, 13%. And then again, here go 20% and things like that. Uh, Somebody said I can't, but I can't see period. But no, I see it. I see it. You good, Alex? And then so that's really one of the nuances. But with the Qs, it's the same. It's the same dynamic. I was buying here when it hit this line. Of course, I still wanted to come down here to the 20% down line and 25% down line. I still want that. I do know the volatility for the Qs will be higher, but it's still the same stuff, different laxative. Same thing, different laxative. But you seeing, we got some divergence going on here. The TTM squeeze just turned yellow. So we're gonna see what both of them are doing the same thing. The 8-day moving average is acting as resistance right now, and neither the SPY or the Qs closed above it. But it's still the same traffic as anything else. Uh, if we go to a monthly chart here, it's still the same thing as with the SPY. Over time, is moving higher as the years go. Is moving higher. Right here, this was right here was during the great financial crisis. This right here was during COVID. Look, it's just a little blimp in the screen. And then we got this, and then we got this U-turn, and then we went parabolic to the upside. It's the same thing. So me worrying about what's happening right now don't matter. Me, I'm zooming out, looking at the big picture. So if you're looking at this right now, all right, so right now this is where we at in this little dip right here. But if you look out, this little dip means nothing compared to everything else that happened. And guess what happened? What happens in the future? What happens in the future? It still goes higher. That's the true reality of it. So investing, staying invested, staying consistent, keep on investing. Those are the things that's going to be the hallmark of making it happen. And me, honestly, for the youth, if you got the 529 or if you got a custodial account investing in for kids, and this is what I do with my son, is I invest in mainly the Qs. I believe science and technology is going to be more and more of the future. And so I'm willing to take the volatile strikes or the volatile movement that goes with the Qs in my kids' investments because they work better for the situation. And again, I believe science and technology is going to, go on longer, and it's more advancements in science and technology. And I want my kid to be a part of it. I probably won't be around when he benefits the most out of it, but that's the way I'm playing it when it comes to the youth and younger kids. And you don't have to do nothing crazy. You ain't got to be investing $1,000 a year in a custodial account for a kid, but if you want to, God bless you. But starting off with $50 a month, still investing in one of these two index funds or something, or a mutual fund that mimics one of these index funds. Those are the things that needs to happen. And then you can start at $50 a month, and then once you've taken care of your half, you know, fully funding a Roth IRA, you putting your money in the 401k or whatever that meets the needs of your financial goals. Then if you got extra capital and you want to start looking at the legacy of your children, start at 50, and then when you get pay increases and you can add more, then you add more. That's really the formula that we use. Like I said, it's simple. It's simple in talking about it. It's simple in practice. But the key is you got to keep going out there, putting it out there, putting in the work, putting in the work, putting in the work, and just keep doing it over. Replication, doing it. You got to do it in good times. You got to do it in bad times because again, look, everybody thought right here, oh, this the S&P 500, I mean the Nasdaq is way high. Now look at it compared. This is what 2000. Then we got the dot-com bubble here, but everybody thought the Nasdaq was too high. But now look at it is at 91 compared to 540. So the only thing you got to do is just stay in the game. Just keep investing, keep investing, keep investing, stay in the game, keep investing. That's all you have to do is just keep doing it, no matter good times, no matter bad times. Don't ever let people distract you to say, "Oh, well, don't invest. Why don't you go to the club?" No, invest first, and then if you got money after that, then go to the club or whatever you got left. Maybe you could be like Alex and buy a shot of beer or something, because that's all he gonna buy at the club. Alex, what you
Man.
got?
Nah, I mean everything you said is correct, and that's why we talk so much about the mindset. Because I mean, if you don't have the right mindset and we're in a downturn, you're gonna get scared. If you don't have the right mindset and it takes years and decades to invest to see real growth, you're gonna get bored. You're going to get uh, unmotivated. So that's why we talk so much about the mindset, because without it, you're not going to be a proficient investor and you're not going to see the returns that you might see as someone like Warren Buffett or someone like Kirby. So I mean, you want to stick with it. You want to stay in the market and learn to control your emotions. Um, Emotions I think are the biggest thing that either makes or breaks people in the market. So that's one thing that you always have to control and just stick to it. Like Kirby said, it's simple. You just have to stay on the formula, stay on the blueprint.
Yeah, so Alex, and we're gonna talk about your bread and butter now. I know this is one that all those newbies or people that don't know nothing about the stock market. Do you care if the market goes up or down on any given day, month, year, or anything else like that?
No, not in the grand scheme of things. I mean, I might care if I'm trying to get into a position, and if it comes down, I might be a little bit more excited than if it were up. But in the long term, no, I don't care.
Yeah, and then so give me one of the strategies you use why you don't care? Because people are like, well, why you don't care? If it's going down, that means you lost money. Or when it's going up, you make money. And one part I know Alex is gonna miss over, so I'll say it now. When the stock market goes down, you do not lose money. The asset loses value. But if you hold on to the asset and it goes back up, you gain value. So the only way you lose money if you sell. The only way you make money is if you sell. It's not a oh, it's going down now. Now I'm in a poorhouse. You're in a poorhouse if you buy a stock at 100 and you sell it at 50 or you sell it at 45. Only thing you gotta do is hold it and then let it go back up and then you sell it at a profit. But what happens is, and I'll get into it, but is the emotional cycle start getting hold of you. But Alex, what you got?
Yeah, I mean, so and that's the thing is like when I put money in the market, I'm looking at it as like now I've just converted cash into equity. I'm not looking at it like those stocks are still my dollars. Like I'm looking at it like it's now an equity balance. So I'm not putting money in the market that I need. So my life is still okay. The money that I'm investing isn't going to bankrupt me or not, or it isn't going to take my ability to pay my mortgage away from me or buy food. So my necessities are taken care of. I never put money I need for necessities in the market. So when you're investing, you want to make sure that you're investing with money that you're okay with losing essentially. But in a long term, I mean, I know that that money in the market is for a long term, or it's only to bring me up to a capital amount that I'll need for the next deal. So when I'm investing, I'm not looking at it like, oh, I need that money so I can go and buy an expensive vacation or pay for an expensive vacation. I'm just like, that money is going to grow. And then when I need the next deal, it's going to pay for that. That's honestly the way I look at it. So that's, I guess, my strategy.
Right. And then so going back to here before I go, this is when I talk about the other avenue of it, even when the stock market comes down, I know a lot of people worried about, oh, it feels like I'm losing money. This is This is the exact emotion that people feel when they're in the stock market. So they get in the stock market, they buy it, they want it to go up, they all optimistic. Oh yeah, it's gonna go up soon as I buy it. And then they go excellent, thrilled. Then euphoria hits when it's up. Now you're up, and then it's going to the moon. It ain't ever coming down. And then you won't sell here on the up, but then you get anxiety because it start coming down. Then you get denial, fear, depression, and then now you down capitulation. Now you down here. Then most people get down here. They crying their mama and everything else, and then that's when they sell when the market is down. And then when it starts turning back up, then you get hope, relief, and then you back to optimism. The key of this right here is this right here. You need to turn this thing upside down. This is when you need to turn it upside down. This is when you should be having optimism, and then you want euphoria to hit down here. You want the euphoria to be when the market's down because you want to buy more, buy more, buy more, buy more, buy more. When the market's up, that's when you're like, all right, these people getting out of their minds. They just pushing the market up. It's too high. That's when the inverse emotion should be coming on with the anxiety, depression. And then you should be like, all right, I'm going to take some off the table, especially if you're not in retirement accounts. But if you're in retirement accounts, what I usually do, and I'll show it right here, is let me go back to the SPY so I can. All right, so what I usually do here is when markets start getting into euphoric. So me, I'm all in here. I'm selling the kids diapers. I'm trying to sell the kid everything. I'm trying to put as much money as I can in the market down here. And then as the market goes higher, and it gets 100% over where I bought it, then the only thing I do is that's when I just start scaling back. Instead of putting 100% of every dollar that I can find, I'm scaling back. Now it's 75%. It keeps going higher, then it goes to 50% of money. I'm still investing, but it's less and less and less as it goes up. Then at certain points, I'm just like, forget it, just let it ride. The lowest I go is 25%. And then when I get moves down here like this, like during COVID, when I get a 20% drop, then I'm back to 100% until it goes back over 100% of the previous high. And then eventually I'm back down to 25%. Then I'm back down to 100%. And then this scale here, I get up to here. Okay, now bring it to 50%. 75%, then 50%, then 25%. And actually during this time, let me zoom in. During this time when the market was up here, I'm still investing in 25%. But this is what I did when the market was up here. I sold off shares of different things, and this is outside of retirement account. I sold off some shares. I sold off some crypto, and I paid off 2 rental properties. Start setting up and getting the capital. And the reason why I'm taking the money off the table is not, I'm using it to go party, have fun. I'm taking money off the table so I can have capital when I get something like this come down 10%. I can just go plow money in, or I can look for alternative investment. And then and those were the things that I was doing in this time when the market was going up. And this is a monthly chart. So every tick here, every candle here equals actually a different month. But that's what I was doing. I was offloading shares to take care of different things, taking care of other obligations as far as on the investment front. And then so now I've been waiting for my time. I still got capital left over to put it back into the market to make it shake. That is the real emphasis and the key point of it. So this market can come all the way back down here for all I care. I still have the capital to keep going. I'm all for going for 100%. I'm all for canceling every damn thing in the house. Hey, we back on ramen noodles, and we about to go in here and put every dime in the market. Wife hair ain't gonna be done. Hair gonna be sitting to the side and all that other stuff. I don't care. We'll be all right because we know the truth. This is gonna be the truth. The truth is we're gonna make all this sacrifice down here to make everybody suffer, make my kids suffer. He's spoiled anyway, so he needs to suffer a little bit. We're gonna make everybody suffer so we can accumulate as many shares down here in the 400 range if we get down here, because we want this. We want the next parabolic move up. And all the money that we bought all these shares on discount, that's where we're going to make our profit at in the future. Then they can go back to, hairdos and different laptops and all that other nonsense that, my family do. But that's exactly how I look at the market and what we're doing. Let me see if we got anything else, Alex, on that. If any questions out there. Yep. But yep.
No other questions?
Sorry. Nope. No other question.
No. No, everything you said is accurate. in terms of how to see wealth grow or how to be profitable in the market. Um, it's long term. It's not what you would expect or see from social media, where there's options traders and stock traders. There's a very small percentage of those people. Those are not the majority of who are actually in the stock market. And those people that are making crazy winnings on the stock market, doing day trading, they're trading with way more capital than you have accessible to you. So keep that in mind too. They're pulling in large profits because they're using 100 grand and more to trade with. So don't let social media, you know, change your way on thinking of the stock market or deter you from investing or uninspire you. Just know that investing is a long-term thing. So that's really the only thing I would leave everybody with.
Well, I got one more thing before I end this, and it was going back to the scale of Alex. I thought you was gonna hit it, but you didn't hit it. I'd be setting you up, and you missed the dunk. All right, but I thought you was gonna hit it. But another reason why Alex don't care if the market is going down. This is what this savage is doing. Where is he at? All right, so here, this is what he's doing. So everybody knows that, oh, if the stock market going up, the assets are increasing value. But the thing is, what people don't know is you can make money on the downturn of the market also. So this is another avenue why Alex don't care. I don't care if the market's going down, because we still making money on the downside. We can still sell call options and make income off of the stock market going down. With the stock market going down and we trying to build a position, we can sell put options and they can give us a check every week, every month, depending on how you set up the contracts to pay you for these things going down. The last and then another way you can make money when the stock market is going down.
You could buy
Um, huh?
you could buy
Yeah,
puts.
yeah, you can buy puts. So this right here, this I believe this was the last one that I did puts on, and this is a daily chart. So we got the OKLO sitting up here. Some people in the Discord class is in this was in this, and they probably still is in this stock. And then I had shares in it, but I said this stock went too far too fast, too far too fast. And then what I did was, okay, it's going too far too fast up. Let's go make some money on the downside. So I sold the 35 puts, sold the 35 puts. I mean, no, I bought the 35 puts on there, meaning I thought it was going to come back below 35. And lo and behold, it did. I think it was back here, but lo and behold, it did. It came below 35. I made I think it was a 250% profit on there and like over the weekend, because I put the trade on a Friday. I put the contract out maybe 30 days. It dropped big on the news from DeepSeek, the DeepSeek China thing. And
Mhm.
then I closed out the trade. So it was back here. So I closed out the trade when it came to my support line. And then, of course, it rallied back up. I missed the short again here. I should have put it back on to do it again, but I missed that one. But those are the different things that's out there that you can do to take advantage of the market going down. So you can make money with the market going up or the market going down. Now, how you do it, it depends on the dedication you have towards learning what's going on in the market. But the simple thing to do for people that got 9 to 5 jobs that don't want to sit here and be a stock market nerd or whatever is to get a 401k, get a Roth IRA or a Roth 401k, whichever one you choose, and then put as much money as you can in there and make sure the investment is indexed to the NASDAQ or SP 500, or you can do 50-50, one in each. And then that is how you can build wealth. Just being, I ain't gonna say lazy, but just not being a stock market nerd. You could just put that in there, get it over with, just keep doing it, stay consistent, be disciplined, do it over and over and over and over again. And then life will be way much better on the other side. Alex, you got anything else before we close it out?
Now we'll close it there. Unless
All
there's
right.
anyone else with any questions. But other than that, we'll close it. Well, we'll see you guys on the next live every Saturday, guys, 12 p.m. Eastern time. So stay tuned for the next one. All right. You make sure it canceled the live. It's off now.
It's still going on my side, but give me a second.
Still on your side.
Well, because it's delayed, of course.
Oh, okay.